this portfolio, you're going to kick ass. You're going to beat the S&P 500. You're going to reduce your risk. You're going to increase your profits, and you're going to use your brain to monetize and increase the wealth that your family has. Hello, trader friends. Today I have a very exciting video to show you. I want to show you how hedge funds invest money, how hedge funds reduce risk, how hedge funds increase returns, and this all sounds very fancy, but it's actually very easy, and I'm going to show you how to implement it on your own portfolio, on your own money, so you can make more money and less risk. Alrighty, so let's get to it. So I want to start today with a $1 million portfolio. Of course, if you don't have $1 million to invest or trade, that's fine. You can use a different size portfolio. You can do a tenth of it, $100,000. You can do many iterations. Remember, I like to trade SPX. I like to trade SPY. But of course, there are smaller products that you can use, like MES, etc., that you can size your portfolio to whatever size account that you have. So let me get my beautiful face out of this. And so we're going to start with $1 million. And what I'd like to show you here is how we're going to allocate that $1 million. So the first thing I want to say is that we are going to be looking to invest a maximum of $1 million in the S&P 500, but based on several rules that I'm going to show you. First, the first thing we're going to do is we're only going S&P 500. The SPY is trading around $500 right now. So if we want to invest a half of the money in SPY, you see, we can buy 1,000 shares of SPY at $500. That gives us 500,000 US dollars. You see, so the first thing we did is very easy. We're going to use this $500,000, and let's call it our core position. What does core position mean? A core position means something we are not going to touch. We are always going to have in our portfolios that 1,000 shares of SPY for $500,000. So this is our core. We're not going to change anything. We're not going to touch that 500,000. That's going to be the basis. That's going to be the foundation of our portfolio, and that's going to be the key to give us our winning strategy. Next, when you buy $500,000 in a regular margin account, the brokerage, if you have a regular portfolio margin, a regular margin account, the broker only takes $250,000 as collateral. You see, when you buy $500,000 worth of stock, the computer only takes $250,000 as collateral. So that means we have $750,000 left that we can use to invest. The other $500,000, I'm going to take another $500,000, and I'm going to buy $500,000 worth of treasury bills. Let's say treasury bills right now are yielding about 5%. Interest rates go up, interest rates go down. You can buy treasury bills, you can buy the ETF bill, you can buy SHY. There's a lot of ways you can buy treasury equivalent products in your portfolio, but let's say we're going to buy $500,000 worth of something that yields 5%, and that something will give us a nice return in our portfolios. So now we have committed $500,000 into our core SPY position. We have invested, and the computer only took away $250,000, and then we invested $500,000 worth of treasury bills that are going to be yielding 5%. that means that we're going to get around $25,000 return on that money. And you're going to think, hey, Tony, we still have these $250,000 worth of product of capital that we can deploy. So what are we going to do with that extra $250,000 that we have? So that extra $250,000 that we have in our portfolios, we are going to use as collateral to generate some alpha, some extra return in our portfolios to both reduce risk, increase profits, and that's exactly what we want. Now that we know, let's summarize. So we started with $1 million. We invested 50% of that $1 million. That's 1,000 shares of SPY at $500 for $500,000. The computer only requested $250,000 to do that trade, leaving us with another $250,000 extra that we can use for to trade with. And then we invested half of the money into treasury bills, and that half of the money we are already guaranteed a 5% return for the year. So that's how we're going to allocate that money. Now the fun part, since the 1,000 shares of SPY, I said it's a core position we're not going to touch if the market goes up. If the market goes down, we're not going to touch it. The $500,000 we're not going to touch if the market goes up. If the market goes down, we're not going to touch it. If interest rates go up, we're not going to touch it. If interest rates go down, we're not going to touch it. So that only leaves us $250,000 to play with, right? So when we have 1,000 shares of SPY, what stuff can we do with those? We can do a lot of stuff with that. You know, we can do covered calls, we can do covered strangles, we can do a lot of stuff, and this is what I want to show you right now. Let's go to our beautiful Tasty Trade platform and see what the heck are we going to do with our $250,000 extra collateral that we have. It's very important that you write down that we have 1,000 shares of SPY, right? So what the strategy that I want to show you right now is very simple. When the stock market goes up, we're going to perform a certain strategy. When the stock market goes down, we're going to perform a different strategy. And when the stock market stays neutral, we're going to perform another type of strategy. So since we've only, this is a market that only goes up, 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 up and away, the first thing I want to show you is what to do, is what the hell are we going to do if the stock market goes up? How are we going to utilize our extra $250,000? And also we have a potential to sell up to 10 SPY calls against our portfolio. And you're going to say, why 10? Because we have 1,000 shares of SPY. If for every 1,000 shares of SPY, we can sell one call for every 100 shares. So that means we can sell 500 shares of SPY. So rule number one, write it down, boys and girls. Write it down, trader friends. So first we're going to go and we're going to follow Tasty Live mechanics. We're going to go 45 to 60 days out. We're going to go to the month of March, and we're going to start selling calls as the market moves up. If today was an update, it would be very easy to show you. Since today is not an update, what I'm going to show you is, I'm going to show you anyways what to do it. The first thing I like to do is I like to sell one call at the 30 delta. Let's find the 30 delta. The 30 delta is here at the 520 strike, and boom, we're gonna sell one call for $370. Let's go back to our beautiful screen and let us write it down. Okay, so here we can see we're choosing the $520 strike in April, which is 52 days out, and we're going to collect $3.53. Now let's go to our little notebook and see what the heck Tony's doing. So let's go and take a look at our little whiteboard and take a look at the rules that I'm saying. So we have 1,000 shares of stock. We can do a maximum of 10 calls against those 1,000 shares. This is an important rule here. I only want you to be able to sell a maximum of 7 calls. Why a maximum of 7 calls? Because I want to under hedge. I want to under hedge on the upside. Why? Because the stock market goes up most of the time. So if we end up selling 10 calls against our 1,000 shares, we might get called out of all our shares, and then we will be in trouble as we will no longer have any shares of SPY. Always, another rule, always sell the 30 delta call. Always sell the 30 delta call. Always 45 to 60 days out, and never get assigned. Roll and roll and roll the call. If you get assigned and the market runs up crazy on you, and you get assigned, then we're going to do a wheel strategy. Please go and back and watch my video about the wheel for those shares that we're gonna get called out. So here comes the key to the strategy. As you know, the best traders in the world reduce cost basis. The key to this strategy is constantly reducing cost basis. And if we sell one call here, we're going to have a potential of 6 extra calls to sell. But all this premium, all this money that, do you see that? How the computer created a little circle? I love that. All this money that we are collecting by selling calls, you know what that money is doing? That money is reducing our cost basis. If we got $3.75 for that call, that means on a portion of our SPY position, we already reduced our cost basis $375. So this is the strategy. Every time we go up between 0.5% and 1%, we are going to sell 1 extra call. And what does that mean? That means we're not going to sell all the calls at the same level. We're not going to sell the calls for the same prices. We're not going to sell the same expirations. What we're going to do is we're going to do a ladder. What does a ladder mean? A ladder means, for example, the first call here we sold for the $520 strike. Then if the stock market keeps moving up, and then this one becomes the 30 delta, we're going to sell this one as our second call. If the stock market keeps going up, we might sell this one, and maybe time elapsed even more, and then we have to go and move on to the next expiration, and then we look for the 30 delta call again, and we keep selling and selling and selling calls against our position as the market starts going up. But what is Tony's rule? What is Uncle Tony's rule? We're only going to sell a maximum of 6. That means 60% of your position. Why? Because I want to be under hedged. Why are we laddering the calls up? The reason why I ladder the calls up is because I don't want to take all the risk in one single expiration, in one single strike, because if the market keeps running up, I'm going to feel like an idiot. I'm going to feel like I left a lot of money in the table. So, and also on the upside, never sell 10 calls. Always leave 25, 30, 35%. These rules are not set in stone. If you only want to do 5 calls against your 1,000 shares of SPY, that's fine. If you want to do 6, that's fine. If you want to do 4, that's fine. But you have to do some calls against your position, because that's the way you normally reduce cost basis to the upside. Remember, every call you sell, you're reducing your cost basis, making your your core position have a better cost and giving you a better probability of success. Now, if you're starting to get the picture of what we're doing, if we had $1 million portfolio worth of SPY only, if SPY went down 20%, our portfolio would be down 20%. But if we only have half of our money in SPY and the SPY goes down 20%, now our portfolio would only be down 10%, right? And we're also getting 5% on 50% of our money, so that's another 2.5%. So let's say the stock market crashes 20%. We only have 50% in SPY. Our portfolio goes down 10%, but then we recover 2.5% with our interest from our treasury bills. So in a 20% crash in the stock market, our portfolio would only be down 7.5%. That's nice. That's pretty interesting. So you see, if you think of it that way, you would be less scared to buy a nice core position in SPY. Now, what happens if we start going down, Tony? Alrighty, so let's go to the beautiful, tasty trade platform. Let me clear out the calls. And if we start going down, you see, we have the chance to buy another 1,000 shares of SPY to give us a $1 million complete portfolio, because the computer only requires half of the money to be invested in SPY to be fully vested. Also, treasuries, I know you advanced traders, treasuries also give you margin relief. But let's not think about the margin relief we're getting from the treasuries. Let's just think of our $1 million and convert those $1 million into SPY shares. So potentially we have the opportunity to sell another 10 puts. If we sell 10 puts, we will have a total amount of 1,000 shares of SPY, because 10 puts would convert to 1,000 shares of SPY, and then would have 2,000 shares of SPY, and then we would have $1 million invested in SPY. But how would we sell those 10 puts? So I like to sell those 10 puts in 2 stages. Okay, let's think stage number 1. Stage number 1, the market is going down, but not that much. Let's say the stock market goes down a little bit. Like today's pretty flat. But I also like to, on the put side, I like to go to the expected move. Why? Because I'm always more scared of the downside. The good thing about Tasty Trade, it shows us the expected move here in the brownish color. So what I would do here is I would probably sell the 488 put, and I would start with 1. Right? Why 1? Because I want to be conservative. So I have my 1,000 shares of SPY. I have the possibility of selling another 10 puts, which probably I'm not gonna end up doing anyways, and I want to reduce my cost basis. This $3 actually is reducing the cost basis of your first 1,000 shares. I know you are committing to buying another 1,000 shares of SPY if we crash down to the 488 level. And 488, believe me, it's not that far away. It looks far away, but it's not that far away. So same as with the calls, every half percent to 1% down, I would start selling these puts down. Let's say we keep going down, and then I would sell a second put, and then we keep going down, and then I would probably sell a third put. Now, after I have 3 puts sold in one expiration, if we keep going down, I would probably not stay on this expiration and probably go down to another further down expiration, and I start selling puts in May. And when do you stop selling those puts, Tony? Well, these are very, very important questions, and these are interesting questions. What I like to do is I have the possibility of selling 10 puts, right? So I like to sell only 4 puts out of my maximum 10 puts. And why is that? Let me go to my little chart and let's put it here in writing, because I know a lot of you like rules. I have a friend, Chepa, who always is asking me, Tony, give me the exact rules, give me the exact rules. So here you go. I'm going to give you the exact rules. So same thing, we're going to sell one put for every half to 1% down. We're going to sell one put for every half to 1% down. And I like to do a maximum of 4 puts. I know we can do 10 puts, but how am I going to deploy the rest of the puts? Of course, if we're in a bear market, the stock market is going to keep going down, 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 and then we're going to be selling puts, 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 puts. And I know all of you, you're going to be scared. You're going to say Tony's an idiot. Why is Tony keep selling puts, puts, puts if the stock market is crashing? The reason why you keep selling puts is because you want to reduce your cost basis. You want, number one, you want to buy SPY. You want to buy SPY lower than the cost of your core position. Let's say your core position has a cost of 500. So anything that you buy below 500, I think it's a win. Why? Because you lowered your cost basis. Benefit number two, every time you sell a put, you collect money, you collect premium, right? If you're selling it at the expected move, that means 70% of the time you're going to keep that money in your pocket. And that money in your pocket is reducing cost basis. It's cost basis reduction. Trader friends, this is the name of the game, cost basis reduction. So when we go up, let's recap. When we go up, we're going to start selling calls to the 30 delta. Always 45 to 60 days out. Never get assigned. Keep rolling it, keep rolling it, keep rolling it. I like maximum of 70% of my position. On the way down, I only like a maximum of 4 of the 10 puts. And now I'm going to show you what I like to do with the other 6. So for the other 6, I like to do a 1-2-0 strategy. Why? Because I also want to benefit if the stock market goes down. Now let's go back to our beautiful Tasty Trade platform, and I'm going to show you why I did not keep selling puts, just naked puts against my portfolio. So if we're going down and I already sold 4 puts, that means the stock market at least is down 3 to 4%. The VIX is probably very, very high. And I do want to keep adding puts, but I want to keep adding puts that give me a benefit, that can make me a little bit of money on the downside. So if you remember my 1-2-0 portfolio trade, which is my favorite trade, what I would do is I always start at the 25 delta. Remember, we would buy 1 here, and then we would look for 2 puts to sell that will give us a $10 credit in SPX, $10 to $20 credit. And on SPY, that means would give you a dollar to $1.15 credit. So if we want to receive a $1.15 credit and we're selling something for $3.60, then, if we need to sell probably something that's around $2.50 or 60 cents. So here we grab this one, we add it here, and here we're getting that same $15 that we would get on a 1-2-0. So what does a 1-2-0 comprise of? The 1-2-0 is comprised by 1 long, 491 put here, example, and 2 shorts here. So how many net long short puts do I have? Actually, net, I'm only having 1 extra short put here at the bottom. Why? Because 1 against 2 gives me a net of short 1. Now let's take a look at the analysis page, and let's take a look at why this trade is different, why this trade is interesting, why this trade is something that I really like. Because if the stock market keeps going down, I want to be greedy, and I not only want cost basis reduction, I also want to benefit from a slight down move. So if the stock market goes down, and the stock market is here at a little flag, like our golf flag here. If the stock market goes down, I do want to keep adding naked puts, but I want to add the rest of my naked puts as 120s. Now, how many 120s can we add? Well, based on what I told you, we can add a maximum of 6 120s. Of course, that would be very aggressive, I know. But you can add maybe another 3 120s, and that would give you a total of 7 naked puts. So on the put side, you would have 4 naked puts, and then you would have 3 120s. And the cool thing about the 120 is if the stock market keeps going down and we're really on a bearish stock market, we will benefit. We will hit this little circus tent here. And we actually will be rooting for a down move on the stock market, right? So that will give us a two benefits. One, we make money on the downside. Number two, we're going to buy more SPY at a lower price level. Now, let's do a little recap. Let's do a little recap of where we are right now, because I don't want to lose you guys. I want to see if we're all the same page. So when the stock market goes up, we start selling calls. 30 delta. 1, 2, 3, 4, 5, 6, 7. Max, we stop. If we start going down, we sell puts. 1, 2, 3, 4. We stop. Why? Because we already sold 4. That's enough. If we keep going down, we're going to start doing 120 one time, 120 two times, 120 three times, for a total of 7. Boom, we stop. So all these sales, all these trades, what do you think it's doing? All these hedges are putting money in your pocket. They're reducing your cost basis. So what does that mean? That means that you, by doing this very simple strategy, you will be outperforming the S&P 500. You're going to be killing it because you are going to have a lower cost basis than the S&P 500. And believe me, all the people that do this strategy beats the S&P 500 between 300 and 400 basis points. What does this mean? If the S&P returns 7%, that means this strategy should give you 10 to 11%. Now, if the S&P went down 5%, maybe you even broke even. Maybe you even made money. So that's pretty cool. So if you want to outperform the S&P 500, do this. Now, as you know, markets can go up, can go down, and can stay flat. So what do we do if the stock market stays flat? And if you really think the stock market's not going to move, what we're going to do is we're going to do what is called a covered straddle. What does a covered straddle mean? It means we are going to do both the call side and the put side in both simultaneously, in both ways. So how do we execute a covered strangle? So a covered strangle means, remember we had 1,000 shares of SPY. So the first trade that I would do is I would go to the expected move 45 to 60 days out. I would sell the expected move call here. I would do the expected put trade here. And what does this thing look like? So this thing looks like this. We have our shares here, and we are selling a strangle covering our shares and giving us a profit both on the upside and both on the downside. This, imagine having a house up for rent, and what you're doing is you're renting it out. You're renting out 100 shares of your 1,000 shares of SPY in exchange for this $600 maximum dollar profit. So that's not bad. Hey, if you have a $500,000 home and you're collecting $600 of rent for only one of the 10 rooms in your house, I think that's not bad. And why 10 rooms? Because if you look at every 100 shares of SPY as a bedroom in your house, you could potentially sell 10 rooms, you could potentially sell 10 calls, and potentially sell 10 puts. Now, you guys are starting to get the idea of how the most successful hedge funds trade. So the most successful hedge funds like to do this strategy. They start with their maximum allocation. They only invest half of it. Here we can see they only invest $500,000 of the potential $1,000 that you can invest in the. Now you guys are starting to see how hedge funds trade. They're not smarter than us. They're not more intelligent than us. They probably know less strategies than us, more advanced traders. And what they do is actually very simple, but very smart. What is the first smart thing that they do? The first smart thing is they don't put all their money in the stock market at the same time. They only invest half of the money, half the $500,000. What do they do with the other half of the money? The other half, they put it in treasury bills, right now yielding 5%. Now, that $500,000 that they invested in SPY gives them, imagine they bought a multifamily building with 10 apartments, or they bought a home with 10 rooms. Each apartment, each room can be rented out. How do you rent it out on the call side? We're going to sell one call, and we're only going to rent 7 of our 10 apartments. Why? Because I don't want to cap the chance of my building going in price up a lot. So we're only going to do 7. We're going to sell the 30 delta. We're going to 45 to 60 days out, and we're going to keep selling them for every 0.5%, 1% up. Now, on the downside, since we have cash in our pockets that we can buy another 10 apartments or 10 rooms in our house, we're going to start selling puts. We're going to start selling 1, 2, 3, 4 short puts as the stock market goes down for every 0.5 or 1% that it goes down. And after we sell the 4 puts, we're going to start doing 1, 2, 0 trades. And if the stock market doesn't move, if you think the stock market is going to stay very neutral, then you're going to start doing is selling both sides. You're going to sell the calls, you're going to sell the puts, and then we're going to have this beautiful circus tent. I am not a great fan of the covered strangle. I might have 1 on or 2 on against 10 of my 10 possible shares, and because sometimes I like to be a contrarian. I like to fade moves. So I prefer selling the calls when the market goes up. I like to selling the puts when the market goes down. If you sell both of them at one certain time, you don't know if the first move is going to be up or it's going to be down. If the stock market doesn't move, then great, bingo, you collect both sides. But I even like to sell, even if you want to do a covered strangle, wait for an up day to sell the call, and maybe hopefully the next day is a down day and you sell the put, and then you can convert this covered strangle. And now, do you think you guys can do this? I think you can do this. Now, in order to be very successful doing this strategy, in order to be a really, really killer hedge fund manager, that requires skill. Skill requires experience, and experience requiring doing it. Why, if I do the same strategy that you guys are doing, why do I make more money than you guys? Because my timing was better, because I analyzed the stock market better. I was more opportunistic selling calls. I was more opportunistic selling puts. I was more opportunistic doing 1, 2, 0. I was more opportunistic doing covered straddles. So I'm just showing you what to do. Sell calls to the upside under hedge, never the whole position. Sell puts on the downside in order for you to buy SPY at a lower price with a lower cost basis. If the stock market stays in the middle, search cover strangle. If we really start going down hard, then do 1, 2, 0s. The 1, 2, 0s will help you profit from a down move and also give you a lowered cost basis. Now, I wish there was a recipe that I could give you the exact moment in time when to sell the call, the exact moment in time when to sell the put. If I had that crystal ball, then I wouldn't be here doing YouTube videos. I would be living in the Maldives in my private island run by the Four Seasons that cost $100,000 a day. I probably wouldn't do that. I would still be doing YouTube videos and try to help people out. So if you want to run money like a hedge fund manager, like a professional trader, you want to reduce risk. If the market crashes, you're going to be happy. If the stock market goes up, you want to be happy. If the stock market stays the same, you're going to be happy. Why? Because you already have a strategy for each type of move. If the stock market goes up, you're going to be happy because you're going to be selling calls. If the stock market doesn't move, you're going to be happy because you're going to be selling covered strangles. If the stock market goes down little by little, you're going to be happy because you're going to be selling short puts. And if the stock market goes down very nasty, very heavy, you're going to start selling 1-2 zeros that have a very, very high probability of profit and could also protect your short puts. So this type of trading is excellent because it gives you something to do in every type of market. Markets that go up, market that stay the same, market that go down. And there you have it. This portfolio, you're going to kick ass. You're going to beat the S&P 500. You're going to reduce your risk. You're going to increase your profits. And you're going to use your brain to monetize and increase the wealth that your family has, fought very hard to accumulate. Now, if you got married to a rich person and you inherited this money, good for you. But for the rest of us who have worked our butts off to save some money to have it in the stock market, I think this is a much safer, much wiser way to invest $1 million by doing half and doing the other half selling premium against your positions. Now, if you want to grow your pile, follow Uncle Tony. If you want to keep growing your pile, trade like a hedge fund manager, reduced cost basis. And most importantly, remember, you gotta risk it to get the biscuit, baby.